So I'll just remind you that you are being recorded. You'll have the opportunity for a Q&A to click in the Q&A at the bottom of the screen and ask any questions. If you're watching us on YouTube, please hit the like and subscribe and notification button so that you're up to date with everything. That does help us, the likes and subscribes. We're going to go over some slot updates for about 15 minutes, and we're going to go over market updates and really just one analyst report that I found interesting. And then our financial planning topic today is year-end planning. So here we are, it's nearly November, well into about 1/3 into the last quarter of the year. And it's absolutely time for year-end planning. So we're going to talk about some of the things that you should be going through and thinking about, and not waiting till the last minute as we're planning for 2023 and wrapping up 2022. So we've got some exciting things coming up, and some excitement happening at Attleboro Wealth Management. So I've been talking about the development of the website, of course. We also had a new advisor, financial advisor, join us in early October. You'll meet her eventually. Her name is Dawn Santiorelli. She's also a certified financial planner. She's also part of the Slott Group. That's where I met Dawn. So she joined us in October. We also have a new individual joining us on Tuesday next week as another financial planner and investment consultant in the firm. And her name is Kathy. And Kathy has a long background. She's a chartered financial analyst. She's also will be obtaining her certified financial planner designation, but CFA, a chartered financial analyst, is a very, very well-respected designation in the industry when it comes to investment planning. So it's going to be a great resource for our firm. And then we have another person joining us in a couple of weeks as a first helping us in our planning division, and then as a financial planner, maybe in 6 or 8 months. But we'll talk more about him when he's ready to come on board. But some really exciting things happening in with Attleboro Wealth Management. So tomorrow night we have Heather Schreiber joining us. So Heather is nationally recognized as an expert in the area of Social Security planning, and I spent some time with Heather over the few days in Las Vegas at the Slott event. Heather is really brilliant, I have to tell you, when it comes to Social Security. She did a breakout session with several hundred advisors, and she was fielding all kinds of difficult questions, and she just nails it every time. But we're going to talk about several things, and but a few of them are what the historic 2023 cost of living announcement means, why making a claim decision based on a break even could be short-sighted, and why working and making a claim may cause more than a higher tax bill, and other issues. So they're just a couple of things. So we're going to spend time with Heather tomorrow night at 6:30. You all should have received a invitation. If you haven't registered already, I know many of you have. If you haven't registered already, please do so. It should be a lot of fun and some great information. But as always, that will be recorded, and we'll send out a copy of that if for some reason you can't make it live. So we talked about the year-end planning. We're going to talk about today some of the headlines. We know that Social Security announced an 8.7% cost of living increase for 2023. So if you're collecting Social Security, you might be saying, yay, that's great. And it is great in helping us in some degree handle this, crazy inflation situation that we have. But it means a couple of things that aren't great. First of all, more people are going to be subject to taxation at higher levels of their Social Security, because the measure of how much of your Social Security is taxed is based on a calculation known as provisional income. So you've all have learned this before, either through these webinars or through the class, but provisional income is the income that the IRS tracks to determine how much of your Social Security is taxed. And those thresholds haven't budged, right? So if you're a married couple or anything over $44,000, up to 85% of your Social Security is subject to tax. That's been that way since 2022, 21, 20, all the way back to 2015, 20. I can't remember the last time we saw an increase in the provisional income. So those levels stay here. The inflation adjustments for Social Security continue to climb. That means more and more people are going to have to be subject to tax on their Social Security. Of course, there's potentially planning you can do, shifting money to Roth IRAs, cash value life insurance policies that are properly structured, those distributions do not cause your Social Security to be taxed. So that's some planning that you can do. The other issue is that the more Social Security benefits that are paid out, the faster those trust funds are going to be depleted. So I just wrote myself a note here that, and I keep the tables from the Social Security trustees, Social Security and Medicare trustees report that's published every year. I keep them in these notes so I can refer to them because in my running webinar notes. So just as a reminder, the Social Security trust fund is due to be depleted by 2034. That is before this 8.7% cost of living adjustment. So it's likely that that's going to come much sooner now, maybe 2023, 2033. I hope I said 2034 before. But it's just likely to move it maybe a year sooner. And that means only 77% of benefits are going to be able to be payable. So what do we do at that point? Well, that means more tax has to come in either payroll tax or income tax or some combination of the two. So it's going to affect folks. Medicare, just as a reminder, Medicare trust fund is scheduled to be depleted by 2028. So, good news and bad news, right? So if you're collecting Social Security, you get more, but it's going to put more pressure on the trust fund. More people are going to be subject to Social Security tax. The IRS also announced tax inflation adjustments last week. It actually came in, I think, last Thursday, just when I was sitting down for the slot up there, or the slot conference. So about 7% across the board were the increases. So let me just give you an idea. And once I have a publication I can share with you, I'll share it with you. So the brackets we tend to work with a lot are the 22 and the 24% brackets when we're talking about converting funds into Roth IRAs. So they increase, let's see here. I wrote this out, but it's a little confusing the way it was broken down. So at the top of the the top of the 24 has gone from, let's see, 300 for married filing jointly couple, $340,000 to $364,000, $200,000. $364,200. Let me say that over again. I'm still a little jet lagged, I think. But so it's gone from the top of the 24% bracket. Let me be clear on this. Has gone from $340,000 for 2022, $340,100 to $364,200. So obviously that's a $24,100 increase. So that means if you're pushing up to the top of the 24% bracket, which most people are who we work with for the Roth conversions, it's another $24,100 that you could potentially convert over the next several years. That's a big deal. So that is a significant increase, and that's one positive thing coming out of these inflation increases. So for a single filer, it's basically cut in half. $11,600 is the difference there. But about 20%, or excuse me, 7% across the board. Standard deduction is up for married couples filing jointly under the age of 65. That is $27,700. What it was in 2022, or what it is in 2022, is $25,900. If you're over 65, you get an additional increase, currently at $1,400 for married filing joint couple each, and $1,750 for a single filer. I haven't seen if that's been increased, but it may have been. Let's see. The estates, there's also a significant increase in the estate exclusion. So this is a little confusing for people, but the exclusion amount for federal estate taxes is the amount that you can have before you face any estate tax. And for 2023, that's increasing to $12.9 million each per. So if you're married, that's 12.9 times 2. That's an increase of just over $12 million for 2022. So that's significant. Remember, that's set to revert back to the 2017 levels as well, and that'll be just over $5 million. So big changes in the estate tax planning come 2025, the end of 2025, new year 2026. And the gift tax exclusion, so the amount that you can give before you have to file a gift tax return, or before you're supposed to file a gift tax return for 2021 and 2022. Is that right? Let's just look here. It was 16,000. Now it's 17,000 for 2023. So a lot of people are confused about this gift tax thing. You don't have to pay tax on a gift that's over 17,000. Your recipient, of course, doesn't have to pay tax on that gift. Let's just say in 2023, you make a gift to somebody and it's $18,000. So 17,000 of that is the exclusion amount. You file a gift tax return for the extra 1,000, and that comes off of your estate tax exclusion amount. So $12.9 million in 2023 will be reduced by that $1,000. So that's how that works. It's the simplest I can put it. A lot of people get confused by that. So we're going to talk about the markets a bit, but last week was a big week. I was watching it during the week when I was away, and really what caused that seems to be better than expected earnings, across many areas. And there were some issues that Russia faltered a bit with its war in Ukraine. So maybe some positive news there, if anything can be positive coming out of there. All right, let's talk about our Ed Slott update. So there's a couple good pieces. I'm going to share my screen here in a moment. And as I'm reading this, I typically like to spend time with these analysts directly when I'm at this, but I just thinking to myself, because I had my family with me. We were so busy, like after Thursday night, we had to run out and meet Elvis. I just love saying that, but so I didn't get the usual time to spend time with the analysts. And I, like Sarah Brenner, who you should see in front of you now. So just raise your hand if you can see the clock is ticking on 2022 conversions. No? Okay, great. Thank you. So Sarah's wonderful, and she's a lot of fun to spend time with too, but she's very, very smart. So each one of these analysts takes time to present a topic, and then and they switch back and forth, and there's often cross conversation between Ed and Sarah and Ian and Andy, and we even had a past person, Beverly, who's really great. Who started with Ed, and she retired a couple of years ago. She came and joined us for a little bit. So it was a lot of fun, but just really, really smart people. So here we go. So Sarah writes, the clock is ticking on 2022 conversions. She's talking about Roth conversions. And I'm right here. Fall is in full swing now with football, foliage, and pumpkin spice, everything. So she's took a little bit from my email I sent last week. The holiday season is just around the corner. Before we know it, the year 2022 will come to an end. If you're considering converting an IRA to a Roth IRA in 2022, the clock is ticking. Here's what you need to know in making this decision as far as deadlines. So the December 31, 2022 deadline, a deadline for 2022 conversion is the end of the calendar year. There is a common misconception that a conversion can be done up to the client's tax filing deadline. This is not the case. If there's one simple tax related thing that I could change in the tax code, if I just had Congress's ear for one thing, it would be a tax related thing. It would be give us until the tax filing deadline to complete conversions for the prior year. It seems like a simple thing. I really don't know why they don't allow that, but it is the end of the calendar year is the deadline for the Roth IRAs, and it's typically well before that. From your custodian point of view. So your investments are held at custodians. So Vanguard, for example, might say, we got to have all the paperwork in and in good order, ready to go, no errors, no nothing by the 15th of December. It might be the 1st of December. Last year, some custodians were telling us mid-November. So, you really have to know your calendar if you want to get these things done. So there's no such thing as prior year conversion. The distribution must be taken in 2022 and reported on a 2022 Form 1099-R. It is best not to wait until the last minute. Be sure to leave enough time to get the transaction done. Don't mess around with this. I've seen it happen where people think they have until the end of the year and they don't. Trading a tax bill now for tax-free gains later. If you convert your traditional IRA to a Roth IRA in 2022, your pre-tax traditional IRA funds will be included in your income for 2022. This will increase your 2022 income, which may impact deductions, credits, exemptions, phase out, and taxation of your Social Security benefits, and Medicare Part B and Part D premiums. In other words, anything on your tax return impacted by an increase in your income. That is a tax hit for sure, but keep in perspective, remember the extra income would only be for 2022. When you're talking about the conversion for this year, many times we're doing conversions over multiple years. The year of the conversion, the trade-off is the big tax benefit. I'm down here now. Down the road, if you follow the rules for qualified Roth IRA distribution, all your Roth IRA funds, including the earnings, will be tax-free when distributed to you. Remember that the consideration is, what is the future of income tax rates? If you think that your taxes are going to be higher in the future than they are today, and I don't know how they won't be, then for most of us, then it makes sense to look at doing a Roth conversion today. Tax rates are historically low, but these rates will not be here forever. There is a window of opportunity to take care of them. The lower tax rates are temporary and scheduled to sunset in a few years. You all know that. Most of you who've been listening for a while are experts at this. The lower tax rates are temporary. I said that while no one can say for sure what the future will bring, the federal government's large deficits make much higher tax rates a likely possibility. Converting now is a way to lock in the low rates of 2022 and avoid worries about uncertainty of future taxes. Good advice, of course, is a must. So let's move on from that. I'm sorry. Let me skip over that. So this is worth reading. The decision on whether you convert your traditional IRA to a Roth IRA in 2022 is a big one. There is not one answer for everybody. That's very true. You hear me say that all the time. Conversion is definitely not a one-size-fits-all proposition. Even in the classes when I do examples, I am constantly saying this is different for everybody. Recharacterization of Roth IRA conversions are no longer available. It means you can't undo it. Once you convert, it's done. This means you will need to be sure that conversion is the right move for you, because there's no way to undo the transaction. Your 2022 conversion will be irrevocable. Not sure what's right for you? Consulting with a knowledgeable tax or financial professional is a great place to start. Thanks for that plug, Sarah. So IRA rollovers in 2021 RMDs, today's slot report mailbag, again from Sarah. So these are questions that go in, and I always find these fascinating. I hope you do too. So the question is, can a Roth a IRA to Roth IRA rollover be spread over two transactions to soften the upfront tax hit? So we know, because we're very much in tune with this, that this person isn't talking about a rollover. They're talking about a conversion. Moving money from an IRA to a Roth IRA is not a rollover. It's a conversion. So Sarah appropriately answers, when a conversion is done, any taxes owed would be owed in the year of the conversion. There is no way to spread that income over more than one tax year. So what the person asking the question is, if I did $100,000 conversion this year for 2022, and my tax owed, for example, is $20,000, do I have to pay it all at once, or can I stagger that over a number of years? Remember, in the beginning of the Roth, that was allowable. You could convert it, and I think it was a 5-year period you were able to pay the tax. People still have that in their head, and they think that even though that was over a decade or more ago, that can still be done. It's not the case. And in fact, to be safe, you should probably pay that tax, unless you're doing withholding. You should probably pay that tax, in the for the quarter when you do it. So if you did a conversion last quarter, you'd have a tax payment coming due. So I would not wait until the April 15 filing date. Okay. So there is okay. She says, however, one possible strategy to minimize the tax bite, I'm right here. However, one possible strategy to minimize the tax bite of converting is to do partial conversions. This is something we do all the time for our clients. We calculate how much we should be converting every year, and we have a schedule of what those conversion dollars should be. Many times people do not want to pay the taxes on a Roth conversion in a tax bracket that is higher than their normal tax bracket. In those cases, a series of small Roth conversions done year after year could be the answer. You fill up low tax brackets with amounts converted to a Roth IRA. That's what I was just talking about with the 22, 24% brackets. They're our favorite tax brackets to work in with Roth IRAs, Roth IRA conversions, because you can move a lot of money just in those brackets for incrementally smaller amounts. Okay, next question. I'll just move this up. So I'm here now. Hello, I recall your discussion of what the requirement will be for taking 2021 RMDs during the 10-year rule for IRAs inherited in 2020 from owners who had reached their required beginning date prior to death. Has there been a determination on this question? So this has been very, very confusing for folks. So I'm just going to say it again. Remember, the Secure Act changed the nature of inherited IRA distributions. You used to be able to transfer the money directly into an inherited IRA, do what was referred to as a stretch IRA, and take distributions over your life expectancy using the IRS table. The Secure Act ended that for most beneficiaries, other than eligible designated beneficiaries. And there are only a few of those, a few categories. But if you don't fall into the eligible designated beneficiary category, then you must empty that IRA, that inherited IRA, by the end of 10 years. In the beginning, we interpreted that as very similar to the 5-year rules, and that there were no RMDs due during that time. It had to be distributed only by the end of the 10th year. During that, after the Secure Act was issued and the IRS came out and they implied that there had to be RMDs done during that 10-year period and then depleted by the end of the 10 years. But then they came out and reversed themselves and said, we were wrong. You only have to deplete it by the end of the 10 years. And then a proposed regulation came out that said, actually, yeah, we want you to take the required minimum distributions during that 10-year period, but only if the person you inherited the IRA had already started their RMDs. Once you start, you can't stop. So now it's even more confusing. I hope I didn't confuse you more, but you see these questions all the time, and we'll continue seeing because it's confusing. The answer from Sarah is, hi, Mike, in Notice 2022-53, and we talked about that in detail last week, issued on October 7th, or not last week, 2 weeks ago, the last webinar. The IRS waived the 50% penalty for beneficiaries subject to the 10-year rule under the Secure Act who do not take 2021 or 2022 required minimum distributions from an inherited IRA. You can find all the details in the Slott report, and she gives the link. And I can put that in the, I'll put that in the chat so you have it. Where are you? Let's see if this works. All right, you should have that link if you want to use it. So you can see how confusing this is, right? Even the IRS came back and said, okay, we understand that it was confusing. We understand that we gave you really spotty information along the way. So if you didn't take an RMD and you were supposed to in 2021 and 2022, we're waiving the penalty. Now, going forward, you've got to take those RMDs if you're not an eligible designated beneficiary for an inherited IRA. There's no waiver of RMDs, even though the markets are down and all of that everyone's concerned about. No waiver of RMDs for a regular IRA, your own IRA. If you're over 72 years old, you must take those required minimum distributions. That we're talking about here, inherited IRAs. So the IRS said, because we messed up so bad, we're going to waive any penalty. So that's good for them. Okay. Let's get back to our information. All right, we talked about Heather coming tomorrow night. One one example of the discussion I want to have with Heather tomorrow night, it came up in our discussion group at the Slott event. Now, remember, I think that these 500 people are some of the best and brightest in the country. But even some of those folks are confused sometimes. And there was a question about, well, wait a minute, we know that Social Security is going to get an 8.7% increase in cost of living allowance this year. So isn't it better to take the cost of living allowance rather than just the normal 8% increase in benefit? Now, what are they talking about? Every year you delay, and it's actually a monthly incremental benefit, but every year that you delay from age 62 to age 70, you get an 8% increase in your benefit. So people refer to this as an 8% pay raise. It's a very common known thing. So this person who's a financial advisor, financial planner, part of the Slott Group, I'm hoping a new member of the Slott Group, said, wait a minute, if I only get 8%, if I wait, why not take the 8.7 by collecting it? Well, what he's missing in that, and I think it's obvious, but maybe it isn't, is that it's not an either or. You get both, right? So you're going to get you don't just get that cost of living increase if you take it. It's calculated in your benefit going forward. So so that's important to know, and that's something that I want to talk to Heather about tomorrow night. And that's just one example of some of the conversation. So I hope that makes sense. Let me know if you have any questions on that, because I know it's a little confusing, and I know it's confusing because, like I said, we have financial professionals asking questions about it. And I see a question. All right, so Gerard asked, thank you, Gerard, for welcome back. Would withholding tax up front from Roth conversions possibly work for clients that do not have current funds to pay tax? Often folks have more qualified money. So Gerard when Gerard says qualified monies, he's talking about retirement funds. So qualified loosely means retirement funds. It's not the correct terminology, but that's okay. Technically, qualified funds are only retirement plans, not IRAs, but that's okay. The IRAs, so we're talking about retirement funds. So Gerard is saying, rather than pay the tax out of your bank accounts, liquidate some securities or anything in that taxable bucket, what about paying it from your IRAs? Can people do that if they don't have current funds to pay the tax out of other funds? Well, sure, you can do that. Of course, the math works better if you're converting $100,000 and you can convert that $100,000 and move it directly to a Roth IRA. Now you have $100,000 in that Roth IRA growing tax-free. That, of course, the math is going to work better, but it's typically better to do the withholding than to do nothing, right? The math does work out to do the withholding. Of course, it's better if you're not paying the tax out of the IRA, because remember, using that 20% example, you end up with $80,000 in the Roth, or maybe less, depending on how you're going to structure that withholding, because any dollar that you take out of that IRA also has to be taxed. Even if you're using that money to pay tax, that money also has to be taxed. So let's just, to keep it simple, you have now $80,000 growing in that Roth. So of course it's better if you can pay it out of your bank accounts and your taxable accounts. But if your only other option is to withhold it, that can make sense. And from a tax timing point of view, that's really helpful, because any withholding is considered done evenly throughout the year and you don't have any potential penalties. So good question. Thank you, Gerard. All right, moving on. So let's go into our analyst reports, our market updates. So last week was a good week. The markets overall were up. The Dow Jones Industrial Average was up 5%. Excuse me, let's be exact here, 4.93%. The S&P 500 was 4.75%. The NASDAQ was up 5.22%. Across the globe, we're up just under 1%, as high as 3.25. Still down terribly for the year. The Dow Jones Industrial Average is still down 13%. The S&P is down 20%. The NASDAQ is down 30%. But the worst of it, as you've heard me say, is the bond market. The bond market was down again last week over 1%. So the most typical bonds that people use, and this is because interest rates are going up, is measured by this Barclays Aggregate Bond Index, and that was down 1.0% and down almost 17% for the year. So I see my camera shaking, so because I'm pounding my fist. So maybe you're seeing my frustration, because still people are saying that as the older you get, you should have more money in bonds. No, that's not. You've got to have some more thoughtful process in how you're going to withdraw funds and how you're going to allocate funds in your investments, because this is I've been preaching about this for many years. As interest rates up, bonds go down, and some of them go down very sharply, and people are still surprised to see their bond portfolios go down because they think they're safe. I'm using air quotes for you, those of you who are just listening, safe money. And it's not, right? Because here's a really good example. Even the shortest term bonds are down, as they're measured by an index, 1.1 to 3 years, are down 4.85% for the year. And the U.S. Treasuries are up. The 10-year Treasury is 4.22, up 0.2% week over week. Even the 2-year is up a little bit. And the 6-month Treasury is 4.37. A year ago, the 6-month Treasury was 0.06%. Now it's 4.37. That's a big, big, big and fast move. All right. BlackRock was the only one that really had a meaningful, I'll say, analyst report. If somebody saw something, I'm happy to, you can share it with me. But BlackRock reads, recession eclipses U.S. midterm results. So a lot of people are anxious about the midterm elections, whether they're concerned about it, looking forward to it, and they think there's going to be some kind of positive movement in the market. Who knows? BlackRock is saying this certainty of a recession is kind of taken over any kind of positive vibes about the midterm result. The recession we see from the Federal Reserve rate hikes eclipses any impact from U.S. midterm elections. They say we stay underweight developed market stocks. So not that they don't have any stocks, but they're underweighting them. Yields rose and stocks rallied off lows as markets mold the scope of central bank rate hikes amid a whatever it takes campaign to curb high inflation. They're saying that the Fed is saying, we're going to do whatever it takes. Some people are finding solace in that, and that's what moved the markets. The markets are pricing in another 0.75% rate hike by the European Central Bank this week. And U.S. PCE inflation will be in the focus in the Fed's meeting next week. All right. Let's move into our year-end planning. I don't see any questions. Let me just double check. Okay. So I'm going to share my screen here. Let me make sure I've got this up. Raise your hand if you can see my whiteboard. It says financial planning topic, year-end planning. Great. Now, if you're a client, you've received our form, our year-end planning form. If you haven't filled it out and returned it, please do that. But let's talk about what you should be focusing on. Now, this is very, very simple, but very important to review. The first is capital gains and losses. See this? Okay. Capital gains and losses. So these are for our taxable accounts. You cannot take losses in IRAs. So if you remember our buckets, right? We have taxable, tax deferred, and tax-free. So we're just focusing on this area here. So these are your stocks. See, this is one of the problems. There's such a delay here in this whiteboard. But we have stocks, we have mutual funds, we have CDs, we have cash accounts, we have all this. So, and this is taxable because every year you get a 1099, and you get 1099s for short-term gains, long-term gains, dividends, and interest. So this is a year that we can use this to our favor, the downside of the market, right? Because we can do what's called tax loss harvesting. And we talked about that a few weeks ago in our investment fundamentals series. But many of you have sold positions. Either you needed the money for something, or you just strategically, or we, for you, strategically sold out of positions and you have some losses. So now you also may have some gains, because there are many people who are taking distributions. They have built-in gains over the years, and they may have gains for the years. So you should be looking at, okay, what are my capital gains and capital losses year to date? So you can do some planning on that, because if you have capital losses, it might help save you tax. If you have capital gains, if they're short-term gains, they're going to add right into the marginal tax rate, just like you earn that money. And if it's long-term gains, then it's potentially taxed more efficiently, can be 0 all the way up to 20%, and there could be a 3.8% surcharge tax on that if you make over certain amounts of money. So this is vital, and you don't want to be surprised by this. So it's almost November. You should have a good idea of what these capital gains and losses are going to be, except for mutual funds. So one of the problems with mutual funds is mutual funds trade all year long, and they have internal gains and losses that then they have to pass out to their investors at the end of the year. It's very, very, very common and possible that even if you have a mutual fund that's down for the year, let's just say you have a mutual fund that follows the S&P 500, and you end up being down 20% for the year, you could still have capital gains in that coming out of that fund. And that is a very frustrating situation. So you should be getting notification from your mutual fund sometime very soon about what those embedded gains are. So pay attention to capital gains and losses, not only investments, but also real estate. Some of you have bought and sold real estate throughout the year. Don't forget about that, right? There are potential gains in those real estate investments. For many of you, there certainly are. Some of you may have sold a business throughout the year, and of course, there may be capital gains in that. So you got to factor capital gains and losses in, kind of do a, even just a projected calculation for the end of the year. So because there's still time to do things. Maybe if you realize that, hey, here's an example. Let's just say you've got $10,000 worth of gains in your investments. And then you look at your investment accounts and say, well, wait a minute, I've got $10,000 worth of gains from things that I took out during the year, but if I sell this one fund or this one position right now, I've got a $10,000 loss in that. Now you could sell it today, and if you really like it, you could buy it again in 31 days. And what you've done is you've booked that loss, and that $10,000 loss offsets that $10,000 gain. So then you have 0 tax, right, on that. It's not 0%, it's $0 tax on that. So you still have time, but if suddenly you realize this in January, it's too late. So that's why year-end planning is so important. And I know this is one of the problems, this changes in the whiteboard. It's not as responsive. So if anybody knows Bill Gates, let him know I'm not happy. Retirement plan distributions. So either retirement plan or IRA distributions. Some people forget, believe it or not, that they've taken distributions from their retirement plans or their IRAs. I once had a woman, a longtime client, and she called me one time. This goes back several years ago, but she called me one time. She said, Mark, I can't believe it. The account's down $45,000 since the last statement. And that's just unacceptable. It seems like a lot of money. And I had a reminder that she took a $45,000 distribution to buy a car. And she said, oh my gosh, I'm so embarrassed. But that happens. People forget, or you don't realize how much you've taken. So here we are in October, almost November. Could it be that maybe you did potentially a large distribution early in the year for something that you had planned or unplanned, and it's completely escaped your mind, or maybe in your brain you thought that it was the year before? So review those distributions from your retirement plans and your IRAs or your taxable accounts, even your taxable accounts, because again, you could have capital gains and losses. Now, unfortunately, I showed you up here how capital losses offset capital gains, and there's some rules around short-term losses and how they offset against short-term losses and then long-term. So that's something you can work out with your CPA. If you need help, I can help you. unfortunately, capital gains don't offset distributions, right? So you can if you have more losses than you can take in any 1 year, you can offset it by $3,000 a year. You can write that off against your income, but it's not going to be that meaningful for most people, but it helps. But if you have, say, $30,000 in IRA distributions and you have $30,000 in capital losses, it doesn't mean anything, right? If you can't offset your losses against your gains, you can carry $3,000 forward until they're used up. But don't think that capital gains or capital losses are going to offset distributions or income other than the 3,000. Income projections. You may have worked this year. You may have a bonus due. It's good to do some calculations on what that income is going to be, because there again may be some things that you could do. If you're still working, maybe you can make a Roth contribution. Again, you could do that after the first of the year, but there are you might be able to purchase some equipment or something like that. I don't know, but it's good to look at income projections. Tax payments. So many of our clients are, so we talked about that. Many of our clients are making estimated payments throughout the year. It's good to calculate those and see what you've paid throughout the year and see if you need to catch up. Maybe you paid a little too much. Don't know. But go through your tax payments. Deductible expenses. Did you do any charitable contributions that maybe you weren't planning for, or maybe you were planning for? Let's make sure we're calculating those and keeping those up to date and projecting what they're going to be for the rest of the year or total year 2022. So deductible expenses is another one. And of course, Roth conversions. Roth conversions planned and already completed. Believe it or not, people forget we've been doing Roth conversions throughout the year for many people, whether they were planned or whether they, hey, let's take advantage of the markets being down. It's something we can execute quickly. Take a look at everything. Let's say your plan was to do $300,000 for the year and you've completed $250,000. Let's make sure, first of all, we get that extra $50,000 done by the end of the year. Because once the year passes, as you heard Sarah remind us, that's it. Can't go any further than December 31. And for most people, it's well before that. Our soft deadline is December 1st to have all Roth conversions completed. Our hard deadline is December 15th. So there could be other things too. So we'll just go ... and others and so on. But it's important to look at things for your year-end planning. All right. I don't see any questions. All right. We talked about some slot updates. We talked about the market updates. We talked a little bit about Social Security, and we reviewed your year-end planning for our financial planning topic. That's it for today. It's 10:47. I hope you have a great rest of your day. I hope you have a great rest of your week. I'm scheduled to see you soon. I look forward to seeing you. I'll talk to you soon. Take care. See you tomorrow night. Bye-bye.